Thanks for joining me today. Well, Friday, October 10th was one of the darkest days of my professional career. Indeed, that whole week was one of the most emotionally exhausting times I've ever had in my work as a financial planner. It was a helpless feeling watching the portfolios of my clients in a free fall, melting away like ice cream on a hot summer day, and that went on for 7 straight trading days. And then on that Friday, to watch the Dow hit 7,777 on intraday trading, well, it was pretty overwhelming. Jim Cramer of CNBC's Mad Money in that same week was telling people to sell. Small investors were cashing in their stocks and took out $50 billion out of their mutual funds in just 1 week. I was told investors calling Fidelity were on hold for 20 minutes before reaching a broker. As I watched the panic herd rush to dump stocks, something technically called capitulation, I had a brief moment of wondering if this was ever going to stop, if the down markets were ever going to cease, and maybe if I was the crazy one not to be panicking with them. Of course, that day had all the trappings of a market bottom. Whether it was remains to be seen. In that moment, I found myself wondering if everything that I had learned and believed about asset allocation and buy and hold investing was defective. I wondered if everything that I knew and understood about investments that I had learned along the road of getting a master's in personal finance was just wrong or had changed. I wondered if I had in some way failed my responsibility to my clients. I mean, shouldn't I have seen this coming? Well, regarding that, certainly most of us knew that the real estate party would come to an end. We knew that requiring nothing down and lowering borrowing standards would eventually result in losses to lenders and foreclosures to some borrowers. That was pretty easy to see. What most of us didn't know was the manner in which Fannie Mae, Freddie Mac, and investment brokers pooled and partitioned these subprime loans in a way to get AAA ratings for the parts of them that were really not AAA at all, and then subsequently sold these to brokers and to other investors. And then those investors would use the questionable AAA ratings that maybe they weren't even aware of, that really weren't AAA, to secure short-term bank loans, which allowed them to highly leverage their positions, in some cases borrowing 95%, 97% of the asset value. There were a lot of really sophisticated players very close to the inner workings of this situation. The mortgage lenders, for example, investment bankers, regulators, members of Congress, they all missed the warning signs, which, in hindsight, of course, now appear to be so obvious. Even they didn't see this coming. Still, how we got here is of little consolation to those of us that have lost so much. The portfolios I manage are far more than just numbers on a page and statistics. Behind those numbers are the lives, businesses, and faces of real people. And to watch my clients' holdings be down 25% at the bottom of the fall was as painful for me as it must have been for them. In fact, I wondered whether it may have been more painful for me. I made that assumption based on the fact that I had only heard from about 10% of my clients in the preceding 2 weeks. A lot of them were dealing with the situation by not paying a lot of attention, which definitely reduces anxiety in times like this, and I get to watch it on almost a minute-by-minute basis. Maybe I need to take my own advice and turn off my monitors. But on that one dark Friday, I decided to take the initiative and call my clients. To many financial advisors, this may have seemed like a really dumb idea. A few told me that rather than initiating calls to clients, they were wishing their phones wouldn't ring. And of the clients that I talked with on that day, no one was panicked. They were concerned, but they were all taking the drama of the markets in stride. Some of them were maintaining that perspective, like I said, by deciding not to pay attention, which in the short term is a really good thing. After reaching out to my clients, I actually ended that day in a much better mood. Maybe they really didn't need to talk about the economy, but apparently I did. Thanks for listening.